topic today, and if you have any questions, please don't hesitate to ask them in the chat, so I will gladly answer them. So our topic today is technical indicators. Do they make any sense? And the topic is really important because traders tend to quarrel about this thing all the time. There are different opinions about this matter. Some traders say that it is necessary to focus only on price action, while others are looking for the indicator, the kind of holy grail that will help them find their trading solution and get the best trading signals so that they don't need any other indicators and can just use this one indicator. So there is this kind of constant battle. Some people have the opinion that it is necessary to listen to only the price. Others want technical indicators. And today we will try to explore which way is the best way, or whether there is some middle ground between the two. Of course, technical indicators have their advantages and disadvantages, and well, it is necessary to discuss them to understand which kind of outweigh the others. Do we have more drawbacks of technical indicators, or there are more advantages of indicators? So, of course, the main things why technical indicators are criticized by traders are the fact that technical indicators do lag behind the price, because the price may turn down, for example, while the moving average will still go sideways or even upwards. So it will take time before the indicator reacts to what is happening at the chart. In addition, technical indicators do not take the information out of nowhere. They kind of follow the price, and as a result, when the current price changes, and sometimes that can happen really, really fast, the current recent drawing of technical indicators may change as well. As a result, the indicator may provide us with this confusion because we make our trade on the basis of one reading of the indicator on the one position of the indicator line. Then suddenly this line changes its position, gets redrawn, and well, if we have already entered a trade on the basis of that line, that may be very unfortunate. Next confusing thing may come from the fact that one indicator may say one thing to you, another indicator may hint on quite the opposite thing. As a result, we will see that it is kind of difficult to understand at which indicator to look and which indicator to regard as the greatest authority in this case. That is, of course, a problem, especially for those who just start using technical indicators. We will try to understand how to solve this problem a bit later. In the meantime, another problem of indicators is that they can provide lots of false signals. If you use one indicator to enter a trade, for example, the entire trade system is based on this indicator, you will see that any indicator you take won't give you 100% probability of success. If it did, well, everyone would be using that indicator. It would be a holy grail for traders, and that thing doesn't exist. So false signals, how to deal with that? Clearly, that is against technical indicators. However, the picture is not so bad, and we know that people have been using various technical indicators for decades, and traders have been inventing new indicators ever since. And well, these people who are using technical indicators must have some purposes why they do so. So they might see some advantages to technical indicators, and of course there are advantages. First of all, the most important thing about technical indicators is that a lot of people kind of misunderstand their purpose. The main purpose of indicators is to make market analysis easier and quicker, because technical indicators, in a sense, represent a way to automatically calculate a lot of things about the price. So you don't need to do all the maths yourself. You can just apply the indicator to a chart and quickly, in a matter of a few seconds, get this important information about the price. So indicators help us to analyze the market. Of course, they are purely technical and they are based on the price action we already see on the chart. So they do not really introduce any kind of new information. However, visually, they can provide a lot of important knowledge about the price to quantify, let's say, what is happening on the price chart and represent it in a manner that we can clearly and quickly see what is happening. If you use indicators, you can spot some things that you might have missed otherwise. And during my trading experience, I have spotted that a lot of times, that you kind of look at the chart and you see some chart patterns, you see some candlestick patterns. You can visually understand and visually see where support and resistance lines are, where the trend lines are, but still indicators kind of show you better than where moments the trend is changing or some other things, and you can spot things which you just may have missed, may have turned to another chart thinking that there are no trade opportunities at that chart. So indicators are kind of form a good background for your analysis, even if you base the most part of your decisions on price action. Still, it's worth consulting the indicators and having them as a default element of your chart. For example, I usually have the template that includes several moving averages and some oscillators as well. So then I scan through different charts looking for trade ideas and interesting setups. I kind of expect these moving averages to be there to provide for me the basic framework for analysis. And then there are no such things on the chart. It looks empty and, well, really unhelpful. And finally, indicators can represent a source of trade ideas because we know that a lot of trade systems exist on the basis of technical indicators. However, you would notice that these various trading systems, they are based not on the one indicator, but on several indicators, because only that can allow traders to filter out bad trade signals and leave the signals which have the highest probability of success, thus creating a balanced approach to the market. So trading systems which are made of multiple trade indicators are possible, and they have proven their efficiency. When we talk about efficiency, we of course don't mean that a trading system exists which can produce signals of 100% success, but trading systems with a decent success rate certainly exist. And to make such a trading system, which is made of technical indicators, it is necessary to understand the logic of technical indicators and some important things about technical indicators as well. So let's talk about the things we should do which concern technical indicators. First of all, the most important thing to start is to have realistic expectations about technical indicators. It is necessary to understand that a technical indicator won't be the automatic source of profit. It is just a tool of market analysis which will allow you to understand the market better and pick out the trading opportunities. So if you don't expect something really fabulous from a particular indicator, then you are okay, you won't be disappointed, and you won't expect something that won't definitely happen, because that is kind of pointless. Next, it is important to distinguish between the types of indicators and use them for their purposes. So each indicator has a specific logic behind it. Some indicators are aimed to work in trends and to show the direction of a trend. Some indicators work better in ranges. Some indicators are aimed to show when the market is overbought or oversold. Some indicators show us volatility. So it is kind of pointless to use range indicators when the market is trending and you want to make the most out of the movement in line with the trend. So use the indicator just as they are aimed to be used. And then you try to combine several indicators to form a trading system. You should have the very good idea of the underlying logic of these indicators, of how they really work, and what each indicator aims to do. And this way, if you combine several indicators which have different characteristics and different purposes, is the best way to have this working trading system with highest probability of success. So you can see how the knowledge of technical indicators is able to improve your trading results and the probability of good trades. This is why, on balance, if you speak about technical indicators, I think that certainly the right thing is to acknowledge the weaknesses of technical indicators, be aware of the fact that they can lag behind the price and be redrawn, but still use them in order to make market analysis faster and to create this technical framework which may generate trade signals. Would be interesting to know whether you agree with me or not. So if you have some feedback about technical indicators, please feel free to share it. And in the meantime, I wanted to say a couple of words about some simple but efficient indicator solutions, and just to give you an idea of what I mean when I say that certain indicators have specific purposes. So let's go through some classic indicators. For example, moving averages. I think that MA is the first indicator which is advised to traders who only start learning about what is the market and how to do technical analysis. And in my opinion, simple doesn't mean bad. On the other hand, all really genius things tend to be simple at their core. And moving averages is the indicator I use on the daily basis. So I don't remember the chart I was analyzing without this indicator. Moving averages have several purposes. They help to identify the direction of the trend. And here is everything is simple. Moving average has a bullish bias. The trend is bullish, and the price is often above the moving average in this case, while if the price is below the moving average and the indicator is going to the downside, the picture is bearish. This is the basics, and it's clear, I think, to everyone what a moving average is. But just in case, it is the average price for a certain number of periods, which is moving forward as the price, as new price is formed on the chart. In addition, moving averages provide support and resistance, and this can be clearly seen from this print screen I made from S&P 500 index weekly chart. I have here several lines, several moving averages, which are actually the main moving averages I use. The periods of these lines are 50, 100, and 200, and you can see how these lines, how beautifully they acted as support for the price of this index. So indeed, these moving averages are really popular among traders in various markets. Analysts at large banks usually use these moving averages, and if you read analysis done by some banks, you will hear about 200 period moving average and 100 period moving average. So actually, these periods are the best as support and resistance. Sometimes I add 20 period moving average line to my chart, and in this case, I look for the intersections between this short-term line and moving averages which have bigger period. These intersections help to find the moments when trend changes, when there are some swings of the price. That is also a good signal, which may be a start of a significant trend. Of course, that signal will come a bit later, but still, if the trend is strong, it will last long after the moving averages have intersected. So moving averages, a trend indicator, and I think the simplest tool, which is still a must-have for everyone. Another classic indicator is Bollinger Bands, and this indicator is actually based on moving averages. And if you didn't use this indicator much, I kind of suggest you look deeper into it, because it is quite interesting. It comprises 3 lines. Some moving averages are moved at the standard deviation of the price to create this kind of channel with the middle line, and the channel is adjusting to the market's volatility. As a result, as Bollinger Bands represent moving averages, in essence, they also can help to identify a trend. If the bands narrow, that usually precedes a spike in volatility, as we can also see here from the print screen of Bollinger Bands on the 4-hour time frame of S&P 500. In the middle of the chart here, the bands narrowed, and then there was the break below the support, and the price was for a period of time at the lower Bollinger Band, signaling that the movement of the market is strong. We can trade Bollinger Bands. We can look for reversal candlestick patterns at the outer Bollinger Bands, for example, or we can trade on the price's interaction with the middle line. Of course, it would be better to add something to Bollinger Bands if you plan to use it as a part of trading strategy. So price action and some other indicators would be great, but it can be a basis of a rather interesting strategy, in my opinion. Next indicator, we need to say a couple of words about oscillators to make this picture look complete, because apart from trend indicators, oscillators represent a big part of technical indicators. And one of the most popular oscillators is MACD. And recently I've started to use Awesome Oscillator, which was developed by Bill Williams. And I actually kind of agree with the name of this indicator because it seems rather awesome. It provides technical signals which are, I think, easier to interpret than MACD or RSI. And, well, in my mind, it is really nice. So if you didn't use it before, I suggest you check it out as an oscillator, just to have it at the bottom of the chart, or get it as a part of trading system. Everything is possible here. So oscillators tell us when the market is overbought or oversold. They can be used either in trends and in ranges. In ranges, they are even more important as overbought, oversold signals. Indicators like MACD and Awesome Oscillator, they also tend to provide a lot of different signals, because we get signals when the indicator intersects the middle line. We get signals when the indicator starts to reverse from the low levels and become higher. We get signals when the indicator forms just like this, valleys and peaks. So signals are various, and there is signal line for MACD, and then the price intersects the signal line. It also sends us a message. So different signals are there to incorporate in a trading system. And finally, oscillators tend to show us sometimes the moments of corrections. It may happen that the price forms a higher high, but the oscillator forms a lower high, as actually it happened on the daily chart of S&P 500. The picture is a bit small, but I hope that you can see that the bottom oscillator, the Awesome Oscillator, formed a lower high, so diverging with S&P 500 price. This means that we will likely see S&P going to lower levels. so that the price gets in line with oscillator after this divergence. And I don't remember the case when I saw the divergence of oscillators and the price, and the correction didn't follow at some point. That is, I think, a really good source for trade ideas. So if you spotted divergence, you can just set maybe a pending order on the break of support if it is if the market is bullish and we are awaiting a bearish correction. So not probably enter the market at the current price because there may be still some jerk to the upside. But on the break to the downside, it is possible to trade this divergence. So you can see that such indicators as moving averages and MACD, they look different and they have different purposes, despite the fact that MACD stands for moving averages, convergence, divergence, and somewhere deep in the indicators formula, it is based on moving averages, but it kind of studies these moving averages in a way that it transforms this information and uses it for different analytical purposes. So indicators, oscillators, and trend indicators, they are different. And the fact that moving averages, Bollinger Bands are directly on the price chart, while oscillators are usually before the price chart, below the price chart, that is also emphasizing the difference between these categories of indicators. Final indicator I want to pinpoint in my presentation today is the Ishimoku indicator, and I included it here because, well, this is the indicator I like a lot. It is surely not maybe the best option for beginners, but it is a bit different from what I have explained before. So I think that it should be present here. Ishimoku indicator is also based on moving averages, a big surprise. However, the main difference about this indicator is that it has this multiple elements. So we have 3 lines and 2 lines which form the Ishimoku cloud. And as a result, these multiple elements make Ishimoku a ready-to-use trading system. Sometimes, of course, it is possible to combine Ishimoku with other technical indicators, but we can use it on its own actually if we have a good idea of parameters, settings, and purposes of all the lines here. If you translate the name of this indicator from Japanese, Ishimoku Kinko Hayo, it means one glance at the equilibrium chart. So the idea is that if you have Ishimoku on your screen, on your chart, then you will be able to see what is going on in the market and have a lot of important knowledge about the market just with one glance. And in my opinion, that is a good name and it definitely reflects the situation because to my opinion, it is really so. We can look at the color of the Ishimoku cloud and see the trend of the market. We can look at the position of the price relative to other lines of the indicator and see precisely the phase of the market and get this whole bunch of different support and resistance levels and trading signals. So this is why Ishimoku is so complete. So it provides signals, it provides support and resistance levels, and can be used on various time frames. So you can see that this is kind of another type of indicator, which is, of course, working better than we have trends, but still it allows us to filter some trading signals. So to make a conclusion about technical indicators, I think that it is necessary to see their merits and their drawbacks. And although you should understand that technical indicators come after price action, and in my opinion, good trading decisions are based on price action primarily, still indicators can give you a lot of information about the market. So if you have any questions or comments on the topic, please feel free to share. And in the meantime, I'd like to remind you that Tradimo has the premium program, which will allow you to learn more about the market, to have access to personalized learning support and to various trading signals. So feel free to check the website for premium and subscribe to it to get the service of real quality. The next webinars will take place next week. We will discuss various topics related to technical analysis and trading skills. So feel free to check the schedule at Tradimo website and to register for the webinars. I'm sorry that my image today looks a bit strange, because I only now realized that perhaps it's not the webcam that should work is working. So I see that my picture is a bit pink and blurry. I hope that didn't cause you too much trouble. I have that question from Alberto. Do you have some examples of false signals of the indicators you talk about? Yeah, sure. For example, the false signals can be, try, for example, to apply the indicator like MACD to a chart. And if we read some textbooks or some guidance for this indicator, we will see that when the indicator intersects the signal line to the downside, it is a sell signal. So if we even try to study the performance of this indicator on the historical charts and mark the moments when the price went below, when MACD went below the signal line, we will see that not every time that happened led to a decline of the price. And if we entered the market based on only that consideration, there would be a lot of false moves we would make. So if, for example, we create a trading system, with that, if we add some moving average, maybe on this time frame or on the higher time frame, and then we see that the market is below the moving average is going to the downside. So we decide to look for only sell signals in this situation, and we just drop out the buy signals. MACD provides us focus on the sell signals because this sell signals are in line with moving average. This creates a kind of a filter and increases the percent of good signals we get from MACD. So in this case, moving average will just allow us to pick not all signals from MACD, but some of them. And these signals will be more reliable, that has been tested multiple times in trading. That's why we do combine indicators together. So if you want more examples of false signals, just choose, well, any kind of indicator, see what description says, and try to look for yourself. You will very quickly see that, I don't know, the percentage there, because it surely is not a constant number, but it is not really high on its own, the percentage of good signals every indicator provides. For every indicator that is different, but once again not constant, so we do not see these numbers anywhere, but the understanding that the false signals exist is universal, and well, that is known by everyone. Thank you for your question. So yeah, it surely happens that beginner traders read the information that technical indicators do provide signals. They are kind of relieved that they can only mark the indicators on the chart and then just buy and sell. But soon they find out that it is kind of difficult. And for example, you look at MACD on 4-hour time frame, it is rising. You look at MACD on daily time frame, it is falling. You try to open 1-hour chart, see some other indicators, and the information may be confusing. Of course, the logic of analysis, which tells us analyze several time frames, kind of implies that it's better to start analyzing the market from bigger time frames, and even the readings of indicators are more relevant there because they their calculations of the indicators are based on the bigger picture, and as a result, indicators there also show the bigger picture, bigger trends, so their value is stronger for market analysis. So this is it, guys. I think that we discussed the topic broadly about technical indicators. I hope you liked the presentation, and I'll be very glad to see you at my next webinars with Tradimo. In the meantime, I wish all the best to everyone, and of course, good success in your trading. Thanks a lot, and see you next time.